Are you considering cashing out your 401k due to financial hardship or debt? Unless you know it's in this video, you could end up losing 30% of your money to early withdrawal penalties. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're covering exactly what you need to know before you take money from your 401k or completely cash it out. And we're going to show you how to keep more of your money and tips on how to avoid paying those pesky 401k early withdrawal penalties.
Yeah, Michelle, Americans are taking more and more from their 401ks right now from all the reports that we're starting to hear because high inflation and high medical cost seem to be some of the reasons for it. And according to Vanguard, last October hit a record of 401k hardship withdrawals and as inflation hit its peak. So
sure, it's not shocking, right? And I'm sure that I personally think this is a trend that will continue well into 2023. So obviously, it's not ideal to touch your retirement savings, but sometimes your 401k is your only resource should you need the cash for medical emergencies, to cover basic living expenses if you've lost your job, or you need the money for a down payment on home. Doesn't necessarily have to be for an emergency, right? So our advice would be not to touch your 401k if you don't have to. But if you do, you're going to want to withdraw the money with the least amount of impact on your finances and also your financial future. And that's what we're getting into in this video. And those tips on how to avoid paying penalties, make sure you watch to the end because, every little bit helps.
Yes, it does. And I want to start with covering the downside of pulling money out of a 401k.
Perfect.
This is really important to know so you make the best financial decision possible. First of all, let's start with taxes. Good old tax. You got to pay IRS.
Right.
The IRS, Michelle, requires an automatic withholding of 20% of a 401k early withdrawal for taxes automatically. Okay. So if you take out $15,000 from your 401k, you may only get $12,000 after your taxes are taken out. Along with the withholding taxes, the IRS will also hit you with a 10% penalty on all funds withdrawn when you file your tax return if you're under the age of 59 and a half. So 59 and a half is when the IRS says you can withdraw your money from your 401k and avoid the 10% penalty.
And that amount withdrawn will be taxed as ordinary income for the year it was taken out, which could push you into a higher tax bracket and be forced to pay even more taxes.
Oh, yeah, that's exactly right. So let's go back to the example. Let's say you're under 59 and a half and you pull 15,000 from your 401k.
Okay.
Now you're up to 30% in taxes and penalty. You're now going to get only about 10,500 of the 15,000. You've lost 30% of your money.
Oh, that's quite a bit. And if you don't know this ahead of time and you need a total of let's go back to your 15K example. If you need 15K, you're in for a rude awakening when you only clear 10,500.
That's true.
Yeah. So, all right. So question, how long does it typically take for someone to receive their money if they're going to withdraw from their 401k?
Yes, depends on the administrator of the 401k. Each company has a different process for withdrawals. So make sure to ask your HR department for the easiest steps for you.
Okay, got it. And so the 20% in taxes are automatically withheld from your employer. Is that correct?
Yes.
Okay, and following your example again, you still have to pay that 10% penalty for withdrawing 15K on your next tax return. So 20% is automatically held, and then you're paying that 10% next tax return.
Yeah, IRS requires the first 20% to be withheld. Your employer has to, or administrator, whichever one it may be, has to withhold that. And then the extra 10% penalty comes on your tax return the following year. So, so one thing I wanted to mention before we get into how to avoid losing 30% is the real impact to your retirement is the long-term effects of cashing out or pulling out money from your 401k, especially if you're pulling out when the markets are down like they are right now.
Good point.
This is huge. So when markets are down, when you cash out or withdraw, you're missing out on gains you could have earned had you waited just a little bit longer to pull out the funds. Not only gains as the market recovers, but think about the long-term gains from compound interest over time.
Yeah.
Now, I get that you need the money when you need it, but it's something to seriously consider because this is your future we're talking about. So
absolutely. Amen to that. All right, let's move on to how you can avoid that 10% penalty for withdrawing from your 401k earlier.
Okay. First thing is to see if you qualify for an exemption of the 10% tax penalty. Okay. There are a few ways to qualify. The first way is to qualify for a substantially equal periodic payment plan. With this plan, this is common actually. With this plan, retirement plans can be cashed out penalty free, but this is only if you take annual distributions for a period of 5 years until you're age 59 and a half. But you're still going to pay income tax on these withdrawals. Okay. So that's the first way. The second way is to qualify for the 10% penalty is if you leave your job, but this only applies to those 55 and older. This is what's called the 55 and separated from service rule. This is an IRS policy that allows workers age 55 and over to take early withdrawals from their employer or sponsored retirement plans like your 401k without paying a 10% penalty, provided that they've left their jobs. It only applies to the accounts that you had at that job. You're at your current employer that you just left, and you're still going to owe taxes on the withdrawals, and the funds withdrawn will be taxed as ordinary income.
Yep.
That's the second way. The third way is to get an exemption is if you're getting a divorce and have to pull money out of your 401k to give your spouse. This is common also. If this happens, then you won't be charged a penalty for taking money out of your 401k.
Okay. All right. So hardship withdrawals are also another way to bypass that 10% penalty. Let's go through the details of how this works.
Yeah, hardship withdrawal is a little bit different. It's a withdrawal of funds from a retirement plan due to what IRS calls an immediate and heavy financial need. And if you qualify, you usually don't have to pay the penalty. And so here's some situations that qualify for a hardship withdrawal from your 401k. Medical bills for you, your spouse, dependents, money to buy a house, money to avoid foreclosure or eviction, college expenses for you, your spouse, or your dependents, other things like funeral expenses if you're disabled, adoption purposes, higher education expenses, a natural disaster, or even you're a military reservist. Now, in order to qualify, you need to prove you can't get the money anywhere else and that you can't get a loan and you don't have a savings account. The administrator of the 401k will have to approve this. They want to see the documentation of the hardship. Thanks to the CARES Act, though, of 2020, Michelle, you can take up to $100,000 out for hardships.
Got it.
That was a big change in 2020.
Yeah.
However, though, just because you're experiencing hardship doesn't mean you'll qualify, because employers don't have to allow hardship withdrawals. And if you do qualify, you still have to pay 20% taxes, and it's taxed as ordinary income.
Okay. So I just want to touch on something I think is really important there. You said just because you're experiencing a hardship doesn't mean you'll qualify, because employers don't have to allow them.
You're exactly right.
So even if what the IRS, what did you say? An immediate and heavy financial need. Those are their words. That's why I'm doing my quotes here. But it doesn't, it's up to your employer.
Well, and here's why. IRS didn't set up the 401k plan. Your employer and the plan administrator did. So they're in charge of how that plan is set up. Right. I know many 401k plans and companies that have 401k plans that do not allow hardship withdrawals.
Got it. Okay. All right. So what I've gathered from this is that it doesn't matter which 401k withdrawal strategy you use, that you should only take out the money if you absolutely need it and take the least amount that you need, like the least possible, right?
Yes.
Because even if you get that 10% penalty waived, you're still going to get hit with income taxes.
Yeah, exactly. And one last thing I want to add to, be careful and be truthful in the details of the hardship.
Yeah.
There could be even worse consequences for lying about the hardship. I've seen cases where the employee has been charged with fraud for filing for hardships and not using the funds for that reason.
Eek. Yeah. Okay. Don't ever lie to the IRS.
Yeah. Please don't lie.
Yeah. Oof. Okay. All right. Well, Brian, you have anything else before we wrap up this video?
No, that's about it. And I understand that if you need the funds and this is the only source, you're going to have to take it. Okay. And hopefully today's video shows you some of the ways around some of the penalties and the best way to accomplish your goals. So,
right. All right. Well, if you found this content valuable, go ahead and hit that like button. Let us know that you like the content we're producing. Subscribe, leave us comments if you'd like to. And we're going to put a video below here. It's a question: should I keep funding my 401k or not? If you're wondering that question, check out the pinned comment below, and there's a link in the description, and go check out that one.
Definitely.
All right. Well, thank you so much, Brian. Appreciate this. And thanks to everyone who watched.
Thanks, everyone. Have a great day.